You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest, Senior Options Analyst and author of the Options Playbook. Well, we're taping Options Playbook Radio on the 19th. The markets have closed and the Fed has spoken. Right now, we currently have the S&P 500 index down quite a bit today based off what has happened in the marketplace, which is kind of odd in that the Fed didn't do anything out of the ordinary. It did exactly what was expected. The VIX has been going crazy all week in anticipation of it, and we currently have the VIX index trading at 558, and we had the Dow down 352 points, and we had the SPX down 39 points on the day. So overall, a pretty bad day after the Fed has spoken. They had their big meeting today. So I'm going to look at some bounce back strategies. The trade I'm talking about is a front spread with calls. If you do not own the stock and you do a front spread, that means you are buying one option and selling two other options. This means if you're doing it with calls, you would be naked short a call, which naked calls is not something that we really talk about much on Options Playbook Radio because of the complexity and the ability to lose infinity being naked short a call. The risk is just much too high. But you can attach it to stock, and it kind of becomes a covered call on steroids. And so, for example, let's go on in and let's look at Apple and see what Apple did today. We currently have, once again, we're taping on the 19th. It's Wednesday. The market is closed. And the trade that we're going to look at in Apple is just owning 100 shares of stock. Apple is down $5.18. The last trade was $160.89. A lot of people might say, well, if it pops back up to 170, I wouldn't mind getting out of that trade. I'm looking at the January 4th expiration going out to 2019, and I can see that 70 strike call option is trading for $1.22 on the bid. We'll talk about the midpoint. We'll call it $1.25. $1.25 is where we'd be looking to try to sell a covered call on Apple. So that would give you 10 points of upside, and it would give you $1.25 in premium. And Apple is right now on the close 160.89 minus the 170. That would give you $9.11 of upside. And the premium on top of that would mean $10.23. We're talking about 16 days until the expiration date. So over that time period, a lot of people are going to be attracted to the premium that has been brought in to the marketplace on all stocks, let alone Apple after being down 5 points on the day. So because of that, I just want you to think about an alternative. I don't get to talk about a call front spread that often, but what it will do is it adds a measure of almost margin to your covered call. In other words, you don't get as much up front, but if you are correct and the stock does go to 170, you can make a lot more on the overall capital gain on the underlying stock. And it still gives you a small pillow to land on. So the trade that we would look at, that would be a call front spread. Now, once again, I'm going to emphasize, you need to own 100 shares of stock. This is going to be an alternative to I actually like to call it a covered call on steroids. But here's what we're looking to do. With Apple at 160.89, we're going to go out to the same expiration we just mentioned, the January 4th expiration, 16 days away. And we're going to buy one 167.50 call. And we're going to sell two of the 170 calls. January 4th expiration, 16 days away. We can do this for a net credit of 65 cents to the account. Okay, so let's compare what this looks like when we look at it as a covered call versus doing it as a front spread that is shared with stock, where you own stock. Okay, so the covered call would give you $1.25 in premium. So you get that $1.25 plus you get the capital gain on top of that. So if the stock did go away, you're going to be effectively selling the stock at $171.25, and hence you'd be making just over $10 on that entire trade. Now, if you do the front spread, you are not naked a call option. We're buying one and selling two. So we're basically embedding just a long call spread inside of it. The second option contract, that second call that we are selling, is covered by the long stock and also covered by the long option. But what happens here is from 167.50 to 170, you get a 2.5 point boost if you are correct on your forecast, and Apple gets all the way back to 170. I am long an extra spread that's 2.5 points wide. I can still do this entire trade for a net credit. Now, I'm going to get about half of the net credit that I would have if I just sold the call outright to start with. So on the downside, if I am a little bit more nervous on Apple, or a little bit nervous bearish on Apple, I don't get as big of a pillow to land on to protect myself on the downside. But I get more bang for my buck if Apple does make that dead cat bounce and comes back up. In that, I would get the difference. I still would be, let's say the stock does get to 170 over the 16 days, and Apple would end up getting called away. I still own the stock right now. I had it in my portfolio, and I'm down on Apple. Been down on it for a while now, a few months. Apple has been in the doldrums. And I own it at right now the market's 160.89. I would sell at 170. That would give me a $9.11 of upside on the 100 shares of stock. I would then also get the $2.50 for the width of the long call spread that we embedded in it, and that would add $2.50 in potential profit on the upside. So that $2.50 means that our upside now is $11.61, and then on top of it, we would receive the 63-cent net credit to the account. And obviously, if stock gets called away, we still get that. And total upside then for the stock just getting back to 170 would be $12.24. So this is just an interesting, I'm sure a lot of people are thinking, oh, what can I do to kind of protect myself here? And this is one thing that we can go on out and look at doing a front spread as an alternative to a covered call. Some people will call it the repair strategy, in that I don't want the cheese anymore, but just get me out of the trap. I'm looking for the dead cat bounce, the Fed. I was expecting something else to happen after the Fed, and I figured that the marketplace would, in this instance, I was looking at the marketplace maybe staying at least flat, if not going on up, considering that everybody kind of knew the Fed was going to raise interest rates today. So with that said, let's review exactly what we're looking to do. So I have a stock in my portfolio. It's been beat up a little bit. I've been thinking about doing some covered calls to try to lower my cost basis on it. But here's an alternative to the covered call. We can call it a covered call on steroids. If we do get the dead cat bounce and the stock does bounce back, it will give us more upside. And so we are attaching a call front spread to our long stock position. For a while, we're down on it. It's trading at 160.89. We go out and we enter a trade to buy one of the January '04 expiration 167 calls, and then we look to sell two of the January '04 expiration 170 calls. Effective, I am not naked because I own 100 shares of the stock. I am long one call, and then I am also short two calls in total. This gives me a bonus of having a long spread that's 2.5 points wide from 167.50 to 170. That can give me $2.50 more of upside. I still get a small pill to land on. I still bring in 63 cents to help protect me a little bit more on the downside on the Apple position. And if the stock gets called away at 170, I effectively have a $12.24 gain on this current Apple position from the 160 mark. All right. So it's just an alternative to a covered call. You can do this on any underlying that you would like to do it on. And the biggest thing is that you just want to be able to buy one and be able to sell two to help pay for it on that underlying. And a lot of people are scrambling, wondering what to do. Another alternative, just on some of your long positions, is to think about buying a long put spread. Now, the difference here is that you're actually putting capital out to do this trade, as opposed to bringing capital in on the front spread or the covered call position that we mentioned. So you would go out and look at, let's say we had Apple, let's pull up an Apple chain inside the Ally Invest Index. And a lot of people think about buying protective puts, but what's one of the biggest reasons people are scared of buying protective puts or do not want to is the total cost. It costs a lot more to protect your position on Apple than it would on your house on a relative dollar basis as far as insurance is concerned, because the odds of Apple going down are a lot higher than the odds of your house burning down, and because of that, accordingly, it is a lot more expensive. So let's stick with the same January expiration, but an interesting alternative, instead of just buying that long put outright, if I look at the 157.50 with the 16-day expiration, which is January 4th, that's actually trading for $3.10 on the midpoint on the 157 put. So what could I do to try to lower that cost? Well, a lot of people think of a bear put spread or a put debit spread if you're just bearish on the underlying stock, but a lot of people are thinking of protected puts. They don't have a tendency to think as much about spreading it. So instead of just buying the 157.50 put outright and paying $3.10 for it, let's buy that option contract, but go down to the 150 strike, and we're going to sell that strike. And that's actually trading for $1.30 on the bid price. So I'm paying $3.10 for my protection, the thing that's going to help me out the most on my Apple position if the underlying stock goes down. And then I'm receiving $1.30 for the 150 strike. In other words, I'm worried about Apple going down. I just don't think it's going to go down below 150. So now the total cost of my insurance would be $1.80, and that's something that I can handle. So, and I'm protected from 157.50 all the way down to the 150 mark. So that's 7.5 points of protection. Apple right now is trading at 160.89. So I do have a small deductible, basically from 160.89 down to 157.50. I do not have any protection. But if you're just worried about the short term on some of the FANG stocks or any other stocks in the portfolio that just got beat up, this is a way to do it and get inexpensive insurance that might allow you to stick around, and hopefully we see the markets come back in the new year. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.